Hello and welcome to Invest to the Moon, where I share with you the best tips and strategies for investing in the stock market. In today's video, I'm going to talk about one of the most important concepts in investing, diversification. Diversification is the practice of spreading your money across different types of investments, such as stocks, bonds, commodities, and real estate. The goal of diversification is to reduce your risk and increase your returns by avoiding putting all your eggs in one basket. Why is diversification so important? Well, let me ask you this. Do you know what will happen to the stock market in 2023? Do you know which sectors will outperform or underperform? Do you know which companies will thrive or fail? If you answered no to any of these questions, then you need diversification. Because no one can predict the future with certainty, and investing in only one or a few stocks or industries can expose you to a lot of volatility and potential losses. Now imagine if you had invested all your money in one of those sectors or stocks that performed poorly. You would have lost a lot of money and probably felt very stressed and frustrated. But if you had diversified your portfolio across different asset classes and sectors, you would have reduced your losses and maybe even made some gains. So how do you diversify your portfolio for 2023? Here are 8 strategies that I recommend. 1. Understand asset classes. Asset classes are broad categories of investments that have similar characteristics and behaviors. The main asset classes are stocks, bonds, cash, commodities, real estate, and alternative investments. Each asset class has its own risk-return profile and reacts differently to market conditions. For example, stocks tend to have higher returns but also higher risk than bonds. And commodities tend to do well when inflation is high but poorly when demand is low. 2. Diversify by asset class. The first step to diversifying your portfolio is to allocate your money across different asset classes according to your risk tolerance, time horizon, and goals. For example, if you are young and have a long-term horizon, you can afford to invest more in stocks than bonds because you have more time to recover from market downturns. But if you are near retirement or need income soon, you may want to invest more in bonds than stocks because they provide more stability and income. 3. Diversify within asset classes. The second step to diversify your portfolio is to diversify within each asset class by choosing different types of investments that belong to that category. For example, within stocks, you can diversify by market capitalization, geography, sector, and style. Within bonds, you can diversify by maturity, credit quality, the issuer, etc. 4. Invest in an ETF. One of the easiest ways to diversify your portfolio is to invest in an exchange-traded fund, ETF. An ETF is a collection of securities that tracks an index or a theme. For example, you can invest in an ETF that tracks the S&P 500 index or an ETF that focuses on clean energy stocks. By investing in an ETF, you can get exposure to hundreds or thousands of securities with just one purchase. This saves you time and money and reduces your risk. 5. Consider fixed income investments. 2022 was a tough year for bond investors as interest rates rose sharply due to inflation. Higher interest rates mean lower bond prices, and vice versa. So, if you invested in long-term bonds with low interest rates, you would have seen your bond values drop significantly. However, that doesn't mean you should avoid bonds altogether. Bonds still provide income and diversification benefits to your portfolio, especially in times of market turmoil or recession. But you need to be selective and strategic about your bond investments. Here are some tips to consider. Choose shorter-term bonds over longer-term bonds. Shorter-term bonds have less interest rate risk because they mature faster and can be reinvested at higher rates. Choose higher-quality bonds over lower-quality bonds. Higher quality bonds have less credit risk because they are issued by more reliable borrowers who are less likely to default on their payments. Choose inflation-protected bonds over nominal bonds. Inflation-protected bonds have less inflation risk because they adjust their principal and interest payments according to changes in the consumer price index. 6. Follow a buy-hold strategy. One of the biggest mistakes that investors make is trying to time the market or chase performance. They buy high and sell low, or they switch from one investment to another based on short-term trends or emotions. This can hurt your returns and increase your costs and taxes. Instead, you should follow a buy-hold strategy, which means buying quality investments and holding them for the long term, regardless of market fluctuations. This way, you can benefit from compounding returns, lower fees and taxes, and avoid emotional decisions. Of course, this doesn't mean you should never sell or rebalance your portfolio. You should periodically review your portfolio and make adjustments based on your goals, risk tolerance, and time horizon. But you should avoid frequent trading or speculation based on noise or hype. 7. Keep investing over time. Another key to diversification is to keep investing over time, regardless of market conditions. This means making regular contributions to your portfolio, such as through a 401k plan, an IRA, or a brokerage account. By investing consistently over time, you can take advantage of dollar cost averaging, which means buying more shares when prices are low and fewer shares when prices are high. This can lower your average cost per share and smooth out your returns over time. Also, by investing over time, you can benefit from the power of compounding, which means earning returns on your returns. The longer you invest, the more your money can grow exponentially. 8. Seek professional advice. Finally, if you feel overwhelmed or unsure about how to diversify your portfolio for 2023, you may want to seek professional advice from a financial planner or advisor. A professional can help you assess your financial situation, goals, risk tolerance, and time horizon, and create a personalized investment plan that suits your needs. A professional can also help you monitor your portfolio performance, make adjustments as needed, and provide ongoing guidance and support. To sum up, diversification is one of the most important concepts in investing because it can help you reduce your risk and increase your returns by spreading your money across different types of investments. And that's it for today's video. I hope you learned something new and useful about diversification. If you did, please give this video a thumbs up and subscribe to my channel for more investing tips and strategies. Thank you for watching, and I'll see you in the next video.